So the Chinese electric vehicle maker NIO is gaining a lot of attention lately, some of it for good reasons and some of it for bad reasons. They are basically the Chinese version of Tesla, and a lot of people see this as a golden opportunity to go back in time and buy Tesla a year ago and then recognize the incredible growth that happened over the last 12 months to that company. They think that they can replicate that same success story in NIO. So there's a lot of greed driving interest in NIO, and there's also a lot of fear that's holding people back. It makes for a really tough stock to analyze, but let me tell you what I think.
You have to pay attention to your money.
So NIO's product focus right now is the electric SUV market. They have several models of those, and they plan to come out with a sedan next year that'll further broaden the reach of their market. And I think it will increase the appeal to the more average consumer. I think right now it's focused on that higher end, and that sedan is going to help them push down into that lower end and broaden market reach into additional consumers. So just like Tesla, NIO is very vertically integrated. They have a tight grip on all of the key technology, either by owning it themselves or through very tight partnerships. So these are things like their battery technology, their charging stations, their artificial intelligence systems, the connectivity that drives the cars, all of the manufacturing processes, and they also have pretty good solutions for full autonomous vehicles. Beyond that, they have very broad market reach down into a lot of the downstream market segments. They're into all kinds of additional add-on businesses beyond vehicle sales. They sell batteries and related equipment direct to consumers. They have 24-hour on-demand battery swap services. They sell home charging stations. They even have a very strong service division where they offer courtesy cars during long repairs and easy access to replacement parts and other high-demand service items. They even sell insurance and roadside assistance, which is pretty unusual, but it really makes sense for a company to have that level of integration that deep into the market. So if we take a look at the fundamentals, because they're such an early stage growth company, there's not a lot that we can learn from the numbers. Right off the bat, you can see here they're a $46 billion market cap at the current price. I think historically there's an interesting story here in terms of their earnings per share. I think back here in the latter part of 2018, they hit peak loss. And since then, the story's been getting better and better. And I think they're very close to profitability now. That will probably happen next year. And when it does, I think that alone will cause an influx of buyers and a surge in the stock price. So I think there's some upside there from that exciting profitability announcement that is coming soon enough. In terms of actually looking at the value ratios and the numbers, like I said, there's not a lot that can be gleaned here. They're so early stage. They only go back to 2018 in terms of data, and back then the business was nothing like what it is this year. So it's very, very difficult to draw any meaningful metrics. This one is absolutely a growth play. It is speculative, and it's all about what they can pull off in the next year to 3 years in terms of time frame. So I think it's probably more meaningful to take a look at sentiment when you have a growth stock in this sort of position. So there's a chart here showing the price action over the last year, and you can see through the summer time frame is when things really started to take off, and a lot of things started to happen. A lot of interest was driven by some of that exciting earnings news in the July time frame, and the price started to accumulate from there, reaching a peak here in late November. Now, the volume during this drop-off from the peak in late November, we actually saw this happen on declining volume, which I think is actually a good news story in terms of a pullback. I think what was happening throughout that same time frame as the price was accumulating is that the short sellers here were getting squeezed, and you can see short interest dropping, and it has not yet picked up. It's still quite low overall compared to what it was. Analyst sentiment is dramatically improving. Ever since the news in the summer timeframe was digested, the analyst recommendations have been getting better and better, and they're at a pretty darn good number now at 1.38. The lowest possible number here is a 1.0. So along with that increase in analyst sentiment, the price target has been climbing. Now, this is mostly meaningless. You see this all the time. The price target basically has to be increased in order to keep pace with a rapidly increasing stock price, so there's nothing really new there. I think the interesting thing, though, is to look at the sales estimate that has been increasing in tandem with that price target and the analyst recommendations. I think that there are some numbers in terms of sales forecasts that are driving that increase in sentiment. Certainly, I think that the big money thinks that it can. Institutional ownership has been pretty good. It took a big jump after that favorable earnings announcement through the summer, and it's remained mostly constant through that time frame. So if we take a look at that ownership and what it is, there's a pretty healthy amount of institutional interest in the stock at about 42%. And over the last little while, there has been more smart money increasing than decreasing. You can see here the number of increased positions compared to the decreased positions. There's a lot of new positions being established, a lot more than are actually being exited, which I think overall shows that nobody's heading for the doors right now in spite of some of the negative news. So what is that negative news? Well, a lot of it is political. A lot of these Chinese companies like NIO are now caught up in this whole delisting drama that's playing out right now in the US as the government pushes to potentially delist Chinese companies that cannot meet US accounting standards and oversight. So this is a long-standing issue in the U.S. with foreign companies that are listed domestically. There has been a push, in the domestic stock market for tighter regulation, and it's been very difficult to extend those same standards into foreign companies. And it's very, very difficult to get a good sense of reliability on the numbers that these foreign companies are reporting. In an effort to protect investors, the government is trying to extend that regulatory reach beyond its borders and into some of these foreign companies that are heavily traded in American markets. So on the U.S. side, I think that this delisting bill that's being put forward, it's very clearly a pressure tactic. It's an ultimatum that is meant to both shake out the fraudulent Chinese companies that are currently trading in U.S. markets, and I think it's a threat, or a gun to the head sort of threat, for these other companies to further tighten up their practices. And given the current political climate in the U.S., it has political support at the highest levels. At the end of the day, though, I think this is not a lot to worry about. I think there's been a knee-jerk reaction to this, but fundamentally, I don't think it's a significant threat to a lot of these companies that are actually fairly well run. There's a lot of horror stories out there. There'll be all kinds of scams and frauds in the news with some of these companies. I don't think NIO is one of them. And I think that it's not correct to try to paint all of these Chinese companies with the same brush. There are some very well-run companies like NIO that are not subject to the same level of accounting risk that some of these other companies are. In any event, it's not as though a delisting can happen overnight and suddenly your holdings evaporate. There's actually a 3-year compliance period built into the current bill that's meant to give companies time to come in line with the regulatory framework. And the thing with NIO and a lot of companies that are the same size and at the same maturity level, they really don't have far to go in terms of being compliant with what's being asked of them. NIO is probably already there. And I think that any small tweaks that they would need to make to their underlying business and to their reporting framework would be very easy for them to comply with. I don't see it being something that would drive a lot of change or risk into their business. The other thing to consider is that delisting is a lose-lose-lose for everybody involved, and there's a lot of powerful interests and there's a lot of money on Wall Street that stands to be lost if delisting were to happen. I think that politically it would be a very, very difficult thing to push through to any great extent. So domestically, NIO, I think, is in a good position with the Chinese government. In fact, the Chinese government is a backer of NIO to the tune of about $1 billion directly, and probably more money indirectly through Tencent Holdings, which is also a major backer of NIO. So there's some big money behind it, and the government has put their money where their mouth is with NIO. I think, too, the government wants and needs a success story with NIO. Something at the forefront of clean tech like this is a fantastic story from China. So I don't think the government is going to walk away from NIO. I think the company can count on the government support go forward. And I also think that they're in a very favorable position with respect to regulatory risk. The government is going to give them a pass on a lot of things that could otherwise be problematic for them in a very new bleeding edge technology industry. China is pushing forward with increased regulatory frameworks across the board, and I think NIO would otherwise be at some risk of running into roadblocks there. Given that the government is fully on board with NIO, though, I think those roadblocks will be knocked away pretty quickly if they happen to spring up. So overall, what do I think the outlook is for NIO? Well, I think they have a lot going for them. I think there's a lot of positive aspects. I think they have high quality products that the consumer market is excited about. There's a lot of interest, not just in the company, but in the product, which is really, really key. I think they have demonstrated growth. We've seen those losses shrink quarter over quarter. They're going to get to profitability. I think it will absolutely happen next year. Like I said, they have government backing. The government is on their side, and they have a little over $3 billion in the bank, so they're well funded in the immediate time frame. That I think can easily bridge them to that profitability number and see them introduce some new products next year. Overall, the recent dip that began in late November is, I think, overdone. I think it's a knee-jerk reaction to the delisting threat and some other news. Nothing has fundamentally changed in the business or its outlook. I think this delisting thing will subside soon enough. And in any event, the threat is way overblown. I think it shook out a lot of weak investors, and that more than anything caused the dip. The smart money didn't run. Now, that said, I think that the price action is probably the biggest risk in terms of somebody looking at buying NIO. I think there's further downside price potential. I think that the current dip has probably not been enough to shake out all of those weak players. I think that if there is any further disruption in the news cycle or in the product cycle or any amount of risk, I think there's still further potential for people to bail. And I think you could see the price alone dip just on volatility from here. It's a highly volatile stock. That said, I think there's way more upside potential here than there is downside. I think fundamentally what we can get from a company this early stage is that there's a really, really good growth story here. I kind of buy into this idea that it is Tesla a year ago. I don't like the volatility potential that's there in the price. But if the price does dip below, say, $40, I think I'd be interested. I think I'd probably be a buyer at that level. Given the fact that volatility is so elevated in this one, though, I think I would probably do it by selling put options as opposed to establishing a direct position in the underlying stock. In fact, that's something that I'm probably going to look closely at next week. I could easily see selling some $40 puts into mid-January. So guys, that's my take on things. I hope that gives you some perspective. If it does, please give the video a like, hit the subscribe button, ring the bell, and I'll see you on the next one.